Welcome to Facing the Future, brought to you by the Concord Coalition on WKXL, New Hampshire's talk radio station. I'm your host, Bob Bixby. Each week, we take a nonpartisan dive into topics related to the federal budget, the economy, and how it all affects our nation's future. This week, we'll talk with Peter Fisher, Distinguished Senior Fellow at the MIT Golub Center for Finance and Policy, about what he calls our nation's untethered fiscal policy and what that could lead to. Fisher worked at the Federal Reserve Bank of New York, concluding his service as an executive vice president and manager of the Federal Reserve System's open market account. And from 2001 to 2003, he served as Undersecretary of the U.S. Treasury for Domestic Finance. He had a variety of roles at BlackRock, including head of fixed income portfolio management and chairman of BlackRock Asia. And of course, he taught at the Tuck School at Dartmouth. That's where he's joining. Well, he's joining us from New Hampshire today, not from the Tuck School, but from his home in New Hampshire. Concord Coalition Executive Director Carolyn Bordeaux joins the conversation. Peter and Carolyn, welcome to Facing the Future.
Thank you. Great to be here.
Good to have you back on the show. Well, you recently gave keynote remarks at an MIT Fiscal Policy Conference, and it was titled The Sustainability of Our Untethered Fiscal Policy. And you presented sort of two choices. You started out with a proposition which is pretty unassailable, that our fiscal policy is unsustainable. Most people agree with that. And then you said, well, we have a couple of choices. We can either deal with that problem at its root, in other words, do something about taxes and spending so they're more aligned, or we can rely on the Federal Reserve to mitigate the damages for as long as they can. And I want to focus first on the untethered fiscal policy. Just how untethered are we? I mean, what is the quantity, the magnitude of the problem?
Well, the debt we have and the deficits we have aren't as frightening as the projection that they just get ever larger. So we have an accelerating debt path going forward. And that's really more than, so the debt to GDP is high. It's way over 100% now and headed higher. And it's not really the quantum of it that should disturb us. It's the path. It's the path forward. Now, Alan Arbach in California and colleagues have written that they've looked with mathematical precision to see if Congress responds when the deficit increases or decreases. And in the last 25 years, they can find no evidence that Congress responds. And that's quite different from what happened in the last century. You could see it might not have been sufficient, but if the deficit expanded, you can see Congress would do a little something. It might not be enough. But for the last 25 years, they find no signal. They can't find anything that Congress does. And that's sort of, I didn't focus in my remarks on the technical work they've done, but that's what I meant by untethered. There's no relationship between the revenues this federal government collects and the spending it doles out. And that's what should frighten us.
And two things that results in. One is extremely high interest costs, which are running up right now, which are about at a record as a percentage of the economy. It's over 3% of GDP, and it's getting close to 20% or more of federal revenues, at least in this coming decade. It's expected to be that high. That's pretty extraordinary. That's one consequence. The other one is it just seems to be untethered politics. I mean, untethered fiscal. One is a chicken and the egg.
Well, that's what I tried to point out is I don't think we can expect our fiscal policy, which comes from Congress, to be tethered, to be coherent, if our politics are not coherent. And the two parties don't really talk to each other. They talk past each other. And I think so. I try to draw a line between our untethered fiscal position and our untethered politics. They're just not talking to each other. So we shouldn't, knock our head against a wall wondering, I wonder why we have bad fiscal outlook, because it comes from Congress. Congress has the power and the responsibility to give us a sensible path of spending and taxes, and they are not doing it.
Carolyn.
So that's a perfect segue into a question that we've been asking a lot of folks, which is what happens if we just keep on this path and do nothing? Congress just passed the One Big Beautiful bill that added, is it 3.4 trillion to the debt? Some of that may or may not be offset with tariffs. We'll have to see what the Supreme Court says. But then you have, continuing resolutions, other legislation is going to be on the table. None of it's paid for. And in fact, getting it paid for is barely a part of the conversation. So if we continue on this path, where does it lead us?
Well, not in a good place. I think the most likely outcome is or a prominently likely outcome is that eventually you get rising inflation because the spending of the federal government keeps up a pace. And so that's a stimulant to the economy. And we keep borrowing. And then you approach some problems of hyperinflation. That is, whether inflation is 2 or 3% isn't a problem if it's 15, 20 going higher. And that's the path you can see in other countries where the government just keeps borrowing, keeps borrowing, keeps borrowing, keeps spending. And eventually, I have a lot of faith in the Federal Reserve, but eventually they get overwhelmed. There's not much they can do about it. And you can see this happening in other countries around the world. And so now it's possible that we end up in a non-inflationary place. I don't think that's very likely, in which case it takes longer. So it's hard to put a date on it. I think we miss the point that it's unsustainable. We know it's unsustainable right now. We don't have to project ourselves in the future. And therefore, if inflation doesn't pick up, which I think is not the likely inflation picking up is the likely outcome because of the tariffs, unfortunately. But so it'll happen sooner, the moment where the central bank is overwhelmed and simply by dint of its own mandate, will just keep buying the debt and doing what's been called quantitative easing, but they'll just keep printing the money to buy the debt to try to stabilize it. And that becomes hyperinflation.
Okay. Very helpful for kind of spinning out the scenario here. One of the things you do talk about in your paper that's very interesting is sort of, what are some things, some challenges that the Federal Reserve might face in the near term that precipitate this crisis sooner rather than later?
Well, if the Fed faces, independent of politics and independent of the level of debt, the Fed faces a difficult moment now because we can see the labor market looks like it's not very strong, but inflation is still a little too high. And that gives the Fed a very difficult choice. That would be the case anyway, how to navigate that, whether it be lowering or rates or keeping them firm. But given the politics of accelerating debt and borrowing and the tariffs, which look like they'll eventually pass into inflationary pressures, if the Fed doesn't try to offset those inflationary pressures coming from tariffs with higher rates, then inflation accelerates. And that will make the debt quantity even harder to manage. And we'll see rising interest rates affecting us all with an inflation premium. So it becomes very messy for the Fed. Even it's difficult now, but then it becomes difficult and very messy and very hard to see a good path through.
And tied to that, of course, is the independence of the Fed.
Yes.
And whether they have a choice in whether to make decisions that could tamp down inflation or not. Can you talk a little bit about that and some observations about, what happens if, the president who wants low interest rates gets his appointees on there who are going to deliver on low interest rates and de-link that sense that the Federal Reserve is operating independent of political will?
Yeah, the president has the authority to appoint the next chairman of the Fed. That's going to happen next year, no matter what. And so that has a huge impact. That always has a huge impact. And so it's likely the president's going to appoint someone who is sympathetic to his point of view that interest rates should be lower now. Um, it's not an outlandish view that interest rates should be lower now. I mean, I think that's what's a little difficult. Now, the president has an extreme position on that. They should be much lower right away. But that direction of travel is something that is a respected point of view among economists, and that's why we're at the point of disagreement. Um,
Right.
but for the market to lose confidence that in the Fed's independent judgment, that the Fed is doing its best to balance the long run growth of the economy, inflation, and the stability of the financial system, those are three difficult things to balance. And if the market believes the Fed's not trying to balance them, it's putting all the chips down on one thing, then the market will lose confidence in what the Fed is doing. And that will accelerate the moment of hyperinflation.
We're going to have to take our first break. You're listening to Facing the Future. I'm your host, Bob Bixby. Carolyn Bordeaux and I are talking with Peter Fisher. He's senior fellow at MIT. And we will be right back after these short messages. Welcome back to Facing the Future. I'm your host, Bob Bixby, and Concord Coalition Executive Director Carolyn Bordeaux and I are talking with Peter Fisher. He is the Distinguished Senior Fellow at MIT's Golub Center for Finance and Policy. And we're talking about the state of the economy and the debt and the sustainability of the debt, and what Dr. Fisher calls untethered fiscal policy. And so we were talking before the break about the role of the Fed, how they can mitigate untethered fiscal policy for a while. So let's go back and talk a little bit about what tools the Fed has. I mean, when fiscal policy is, when the government is running big deficits and debt, how can the Fed react, and what sort of tools do they have available?
Yeah, well, first let's just digress a moment further onto the Fed's mission, what it's trying to do, and then what its tools are to do those things. So the Fed, there are different ways of explaining this, but to try to put it in as simple terms as possible, the Fed is trying to make sure the economy can grow as quickly as possible. We'd like to see more jobs, more income, more economic growth, with inflation as low as possible. So that's a difficult trade-off. And then it also, when you can see how the Fed's behaved over the last 20 years, it needs to respond to financial instability. When the banking system gets in trouble or the markets get in trouble, the Fed doesn't want to see a destruction of the economy and our prospects for economic growth because of financial instability. So it responds in addition. So it has sort of three things it's doing. The two dominant ones are grow the economy, keep inflation low, and then let's look out for trouble in the banking system. And it has two simple tools. One, it manipulates interest rates. It can set the interest rate on overnight borrowing because it controls the very short end of our yield curve. So it sets those rates. And then the rest of the market, if you borrow a 2 years or a 10-year mortgage or a 30-year mortgage, those interest rates are set by the markets, by bankers and borrowers. But the Fed has a profound influence over the very short-term interest rates. And then it has some supervisory powers over the banking system. So really, when it comes to these trade-offs between growth and inflation, the Fed is adjusting interest rates. That's really all it can do. And when the government's borrowing a lot of money and inflation is picking up, it needs to try to keep inflation down, frankly, to stabilize the value of all the debt the government's issued. Because if people don't think the value of that debt is stable, they're going to start selling it and interest rates will go even higher. It becomes a bad feedback problem. So the Fed is juggling interest rates to try to navigate all three of these objectives. And that will get harder and harder the more debt the government issues, as the quantity of debt crowds out other things in our economy. So I hope that's an explanation of both what the Fed's trying to do and what its tools are.
That's very helpful. I do have one follow-up on that, which is, can you explain what quantitative easing is? and how
Sure.
that fits into the picture of the Fed's tools.
Well, it traditionally, and when I worked at the Fed, we we grew the balance sheet of the Fed. The Fed would buy bonds and issue money, frankly, is what happens, um, more or less consistent with the growth rate of the economy. There's going to be a certain demand for money, and Fed's very gradually expanding its balance sheet, buying U.S. government securities and issuing money is what the power of the central bank is. And in the financial crisis of 2008 and 9, um, the Fed got interest rates almost to zero, effectively to zero, and it felt that was not enough. They had to do something else to try to stabilize the banking system and stimulate the economy. And then they started issuing more money, buying more government bonds at a much more rapid rate and expanding the quantity of money, even though the price had gotten toward almost zero. So that's what we call quantitative easing. Now, it's still controversial whether it works. Now, working in a banking crisis is one thing versus whether it really stimulates growth. It can do so separately. But the Fed now views itself as having two tools. It can expand the quantity of money by buying bonds, and it can adjust the interest rate. And it thinks to those, it has both those tools.
Okay, and this then leads to a proposal that I have heard about how the Fed can manage through a lot of U.S. debt problems. For instance, let's say if there is a bond sale and it is weak, the Federal Reserve can buy the U.S. Treasuries and, in essence, prop up the United States. Is there the economy, prop up the debt, keep the interest rates low? Is there an end to being able to do that? And I want to talk about Japan and how they have managed through having an enormous debt burden.
Yeah. Well, first, if inflation is very low, as it was in the 2008-9 period, and we were worried about deflation,
Mhm.
then the Federal Reserve can buy a lot of bonds and issue a lot of money, to put it simply, because we're not worried about inflation. It's quite different if we have rising inflation, in which case buying all those bonds is a form of easing monetary policy and will stimulate more inflation, we think. And so it isn't symmetric. The bond buying power. So the story you're telling is that, oh, not to worry, if the government needs to borrow money, the Fed can just buy the bonds and print some money. And I go, well, that might work in really unfortunate conditions of deflation,
Got it.
but it's not going to work if inflation is where it is now or rising, because it'll just make things worse. And so it won't lower interest rates for the Fed to be buying the debt and printing the money. It will be increasing interest rates, not what the doctor orders at that moment.
Want to move on to Japan, or Bob, do you want to ask
Yeah,
Well,
a question about that? Because we have.
I'm happy to go to Japan. I mean, I can, if you want me to go
let's
straight to
let's
Japan.
let's go to Japan because we get that all the time. People will say, "Well, what do you worry about? Our debt may be 120% of GDP or something, but Japan's is 200 whatever percent of GDP." Uh, I don't know that Japan is a great example to follow, but go ahead.
Um, there are a couple of different things to think about when drawing a comparison to Japan. Um, the first is that much of that debt was accumulated while Japan faced acute deflationary pressures, just what I was referring to. So they weren't doing it in conditions of rising inflation. They were doing it in conditions of zero and inflation and negative inflation, deflation, in which case, as I said, it doesn't have the inflationary impact. So that's one thing to keep distinct. Two other things. One, um, Japan may be an outlier in the relationship of being an aging society and inflation and deflation. Japan got old while the rest of the world was still growing rapidly. So it had a shrinking workforce. And but China was growing rapidly. And so in that weird occasion, that conjunction, um, Japanese businesses were moving their operations to China and elsewhere in the world. And Japan faced a sort of unique deflationary pressure from its aging demographic, and the rest of the world is growing and it's shrinking. And we may not be so lucky. That is, we now have slowing population growth and therefore are likely to face slowing growth. That is, as fewer people are added to the workforce. So Charles Goodhart, a great man of English economic, an Englishman and wonderful man and marvelous economist, has rather controversially said that aging societies are going to be inflationary, even though Japan looked like the reverse of that. So that's another. We just have to be careful on comparing ourselves to Japan because Japan was an outlier. The third thing to think about with Japan is another big portion of the debt to GDP. The Japanese central bank used to buy Japanese equities. That is, that they were that they bought bonds and then converted that and moved over and bought the equity market. So they've actually had assets and liabilities. The government, if you consolidate the accounts of the entire Japanese government, they've borrowed a lot of money, but through the Bank of Japan, they ended up buying a lot of equities. So the net debt position is not as stark as the high figures you quoted on debt to GDP. Now, I don't it's controversial whether that was a good thing to do, but it does change your perspective on how high the debt to GDP really is, since they were adding actual assets to the balance sheet of the government, broadly defined.
We're going to have to take our second break. You're listening to Facing the Future. I'm your host, Bob Bixby. Concord Coalition Executive Director Carolyn Bordeaux and I are talking with Peter Fisher, Distinguished Senior Fellow at the MIT Golub Center for Finance and Policy. We'll be right back after these short messages. Welcome back to Facing the Future. I'm your host, Bob Bixby. Concord Coalition Executive Director Carolyn Bordeaux and I are talking with Peter Fisher. He's Distinguished Senior Fellow at the MIT Golub Center for Finance and Policy. He served as Undersecretary of the Treasury for Domestic Finance. And we're talking about the role of the Fed in our rising debt and deficits and what they can do about it, and our untethered fiscal policy and untethered politics. We were talking before the break about the situation in Japan. They have very, very high debt, and Dr. Fisher was pointing out some distinguishing characteristics between our situation and Japan. Carolyn, did you want to follow up on that?
Yeah, so I know you have a lot of experience in Japan. So one thing everybody should know is that uh, Dr. Fisher was worked in Asia for BlackRock, so really know those economies well. Ken Rogoff, in an article for Foreign Affairs called "America's Coming Crash," talks about Japan's, purchase, the central bank purchase of all this debt from the Japanese government. And you've talked some about why there's sort of special and extenuating circumstances around that. But he points out that it's possible that some of that is responsible for the lost decades that Japan has had in terms of kind of slow growth and economic stagnation. What are your thoughts about that?
Well, I've got a great deal of respect for Ken Rugoff. I see it a little differently, but not starkly different. I think Japan had a lost decade in the 1990s. And I think if you actually look under the hood, which I'm sure Ken Rugoff is capable of, and recognize how dramatic the decline in the Japanese working age population was. So they lost from the 90s into 2010s, they lost 10% of hours worked, disappeared. So that's 10% of the economy of how many hours people worked in Japan. What was once the world's second largest economy shrank and but went on a diet. And so it's very hard to sustain growth. And the Japanese actually, in the 2000s and the 2010s, did a pretty good job of increasing productivity, which is all you can do. And former Prime Minister Abe did a remarkable job of getting women into the workforce and improving female labor force participation, extending uh, effective retirement ages. So that helped stabilize the Japanese economy. But most economies in the world would be lucky to achieve the productivity growth that Japan achieved in the last 20 years, even while they struggled with the shrinking economy. Now, that's a mouthful, and it's hard for us to untangle it. And I don't mean to say I know better than Ken Rugoff, but I it's not clear whether the buying of the debt was the problem or the shrinking of the economy was the problem. And maybe the two go together. But I hope that helps.
Yeah, that's helpful. And he just speculated. He did not make any strong claims on that. Very interesting. Bob?
I wanted to, I did want to get back to some fiscal policy things. Carol, no, did you have some other ideas for dealing with the debt that reasons that people have proposed to you that we don't need to worry about it so much?
So one of the other things that I've heard from members of Congress is that perhaps there's an option to selectively default on our debt. So, for instance, default on debt that China holds, for instance. What are the implications of doing something like that?
Um, well, I think it's kind of a fantasy. And I'm going to be really blunt. So, if you become known to be a liar, that you don't keep your promises, how do people know whether to trust you next time? So I just don't think we can say, I'm going to choose the people I like and I'm going to break my promises to them. I'm not going to pay them back. And I'm going to pay back the people I like. Well, how does anyone think you're credible tomorrow or the day after? So I think that's just a fantasy. That's not how financial markets work. I want you to imagine going to your bank and waiting in line at the teller, and the teller just randomly says, every other person, we're going to not give you your money back. I don't think that bank's in business the next day. And so it's just a deep fallacy to think that we can choose who we want to pay back when we've borrowed all this money. Now we can we can try to roll it over if it doesn't get too much bigger. I mean, one of the things Japan has done is it's extended and rolled over the debt, and it's not really shrinking it. And it's still growing, but they're not defaulting on it. They're not breaking their promises to the people who bought Japanese government bonds. That's a foolish path to go down.
And were we to default, the implications would be that all of a sudden interest rates would probably really shoot up, right? And so it would be extremely expensive to finance because you'd have to pay a premium to get
Yes,
people
you
to
have to
actually
pay a
buy it.
premium, but the dollar would probably weaken and interest rates would go up. And we'd find ourselves not as well off as we thought we were. I mean, we'll be the poorer for it. So yes, interest rates are likely to go up. Our financial system would be um, struggling. I was going to say in tatters, but
Yeah.
Well, one of the things that no easy out there. Getting back to the fiscal policy side of it and untethered politics, you were talking in your paper that we were using as a basis for our conversation today that both sides, Democrats and Republicans, suffer from a wishful thinking on the infallibility, I guess, of their own policies, and
yeah,
it's just talking past each other.
yeah. I'm just gonna. I try to be even-handed about this. So one party thinks that we can keep just find our way to balance by cutting spending, even as they lower taxes. It's not, we won't get to balance that way. That's just baloney. It's not going to work. The other party thinks we can keep raising revenues, raising taxes, And even while we increase spending without broadening the tax base, without extending to more people, collecting revenues from someone, and that's untenable too. That's not going to get us there. So they have sort of reciprocal false premises they're relying on, and they're talking past each other. And I really, I thought hard about this. The path to political will being found is when each party will acknowledge that their idea isn't going to work, and then they can do it with each other, and then they can go find some other way. They can try to find some other path. But they won't find the other path, the other ways we could try to achieve balance until they admit they're each going down, that their rhetoric won't get us there.
Are there any improvements in the process, or is this a human nature problem? I mean, should we try something else with the budget process?
Well, it's hard to find something other than Congress taking responsibility. And so the Constitution gives Congress great powers, and we can see that if they don't exercise them and they don't take responsibility for it, where we end up. So I think if I look back at American history and what's different about us, it really was the idea that Congress was given all of the three fiscal powers, the power to tax, the power to spend, and the power to borrow. The Constitution gives them all three. And so that means they have the responsibility. They have to take on the responsibility. And for many years, the chairman of the House Ways and Means Committee was more like a finance minister in another country than our own Secretary of the Treasury. Because in most other countries, in a parliamentary system, the prime minister and the finance minister can choose what spending is because they have a majority in parliament automatically. But here we don't have that, where the executive is separate. So I think we've sort of lost the thread of how our fiscal policy is supposed to work. It's supposed to come from Congress on all three levers. Um, and, um, and they just have to take responsibility. So I don't think there is another way other than Congress stepping up.
Well, we're going to have to take another break, but on that point, I have to note that there are two cases pending before the Supreme Court that will now decide how far we're going to go. One is, of course, on the tariffs, the president's tariff power, which has already been argued, and there's a spending case before the Supreme Court too that has to deal with the reach of the president's power to impound. And a lot of questions are going to get decided that are up in the air right now on kind of where we split it. And that is having an effect on our fiscal policy because folks aren't sure now what the rules are. So I guess we're going to have to go through some Supreme Court decisions and see what we end up on the other side. But I'm not sure we're going to. I agree with you. I mean, really, until Congress steps up, as they used to do, it seems difficult to me to see how you solve this problem. We'll get back to that on the other side of the break. You're listening to Facing the Future. I'm your host, Bob Bixby. Concord Coalition Executive Director Carolyn Bordeaux and I are discussing the nation's fiscal outlook with Dr. Peter Fisher. He is Distinguished Senior Fellow at the MIT Golub Center for Finance and Policy. We'll be right back after these short messages. Welcome back to Facing the Future. I'm your host, Bob Bixby, and Carolyn Bordeaux, Executive Director of the Concord Coalition, and I are talking with Dr. Peter Fisher. He's Distinguished Senior Fellow at the MIT Golub Center for Finance and Policy. We're talking about the nation's untethered fiscal policy, untethered politics, and what Congress and the Fed can or should do about it. We're talking a little bit about the power of the purse, and one of the things that is going to be very difficult to solve our unsustainable fiscal policy is if Congress doesn't come to the table, Democrats and Republicans compromising with each other. And one of the issues that's come up recently is not so much between Democrats and Republicans in Congress, but the administration and Congress over the power of the purse, because the Trump administration has taken a very expansive view of the president's powers with both appropriations and with taxes when it comes to tariffs anyway. Those things are being litigated. You were indicating that there might be some variation in how you feel about the cases going forward as to whether the president is overreaching the executive authority in both the tariff case and in the impoundment cases.
Yeah, well, let me for my sins in my life, I do have a law degree, and I'm a fourth generation attorney. Um, the the tariff case strikes me as not very complicated. I don't know what the Supreme Court will do, but the statute in question doesn't mention tariffs, and that's what the president's been using it for. So I find I'm siding with a number of scholars who say, no, the president's overstepped his bounds. He has many other tariff powers that come from other statutes. But as a matter of statutory interpretation, the one he relied on, I don't think gives him the power to raise taxes on foreign goods coming into America. So that one's simpler. I think the impoundment case is a little subtler. For most of our history, Congress appropriated funds and directed the executive to spend them. And it was understood that if the president could build a road or a bridge or fight a war for less money than had been appropriated, that was okay. That is, he didn't have to spend the full amount. But he could spend, if he could do it for a little less than Congress appropriated, no one was going to quibble. Because these expenditures were discrete, they were targeted. Congress appropriated money to do X or Y or Z. Now, it took until the late 1960s and the President Nixon and Congress in the early 70s for the following issue to emerge after the 1930s. When you enact Social Security and you enact various income support programs that we didn't have for our first 150 years, it's really Congress got annoyed at the thought the president could unilaterally decide to spend less. Congress said, no, we wanted you to spend all that money when we said you should give it to people who need health care, or when we said you should give it to the state of Texas to build something or other. So Congress sort of got in the feeling of, wait a minute, you can't do it for less because the whole point was to spend that money. And that's when Congress enacted, the Impoundment Act came along to prevent that. Now, an interesting question is the Impoundment Act constitutionally required? I don't think so. I think the subtler question in that case is going to be, is the Impoundment Act constitutionally prohibited? And I don't think so either to that. That is, I think it's going to be a tough sell to say Congress can't write an Impoundment Act. But it's not obvious the Impoundment Act is constitutionally required, if you see the subtlety there. So I see much more room for interpretation by the Supreme Court on the impoundment case than I do on the tariff case.
Well, I think the circumstances in both, but on the impoundment case, the circumstances are certainly important. If the president is moving money around, or if he's in effect terminating a program that's been funded, I think that's more of a problem. There is this Impoundment Control Act. Now, the thing that really got Democrats going and causes a little bit of a problem for negotiation on the Hill is the so-called pocket rescission, where the president, and he did it at the end of this year, would wait until Congress was going to adjourn and then send up a rescission message, which he has the right to do under the Impoundment Act. And Congress doesn't have the required 45 days to respond to it. And if they don't respond to it, the president declares that money can't be spent. So it's called a pocket rescission because it's like the pocket veto, which nobody questions the president can do. What I have a problem with that is that if the president is unilaterally, in effect, canceling funds, he's changing the law, an appropriation law unilaterally, which the Supreme Court has said he can't do. That was the basis for the line item veto case. So I think the circumstances are important. And there's certainly a vagueness there, but I don't think that the pocket rescission fits within something that is within the president's powers. The Supreme Court will tell us. I think it's an interesting case. On the tariff case, you look at it on its face and it seems, how can the president get away with this? And then the dissent in the federal appeals court case said, well, look, it says the statute says he can regulate importation. And isn't that what he's doing with a tariff, even if it doesn't say tariff? And it's sort of a case of, how closely does Congress need to write the law? And
well, that's where the major question doctrine comes in. The conservative justices have defended the idea that unless Congress says something explicitly, you can't interpret it. You can't pull something out of whole cloth that's not there. And so I think that's the rebuttal to the appeals court dissent.
I think, thank you for indulging my interest in the, because one of my confessions is I too am a lawyer and I just get really interested in this stuff. I'm not sure that lots of people are quite as interested, but it really is fundamentally very important about the power of the purse. I mean, they're very, very important constitutional questions which have implications on fiscal policy.
Yeah, absolutely.
Carolyn, do you want to, we've still got about 5 minutes here to make sense of the untethered fiscal policy.
I do want to circle back to tariffs because there's a follow-up question in there, which is that the administration has said, well, okay, if the Supreme Court decides we don't have authority through the, like I said, sort of the emergency powers law, we have other authorities to be able to do this. So what do you think the impact would be if the Supreme Court says, well, you can't use that authority? Will the administration be able to legitimately just turn around, impose the same tariffs, keep the same policy in place? I mean, this is important because this money is now being used to offset the one big beautiful bill, right? It is becoming increasingly important as a revenue stream to help, provide some buffer around just continuing to run up the deficit.
Yeah. I don't have can't recite them all. There are a number of statutes Congress have enacted that gives the president explicit power over tariffs and gives them some significant leeway. Not as broad as the powers he's claimed under the Emergency Powers Act. So he will be able to do some of what he has done, but not all of it, is the way I think it's best to understand. So yes, he'll be able to use other powers, but whether he can get the same breadth and both breadth of coverage and, in effect, since it doesn't say tariff power, there's no reviewable standard for questioning what the president does under the Emergency Powers Act. That's another claim against it. It violates the non-delegation doctrine. Congress can't delegate something completely open-endedly. So these other statutes are both narrower in scope and somewhat narrower in discretion for the president, but they still give him a fair bit of discretion. So it's not going to be one for one, but so they'll have to go back and start over again and be subject to much more painstaking review.
Will they have to pay back?
I don't know. That's an interesting question. I wonder if the Supreme Court's going to delegate. Assume for the moment the Supreme Court says no, the tariff power is too sweeping. You don't have that power. I bet they remand it to a lower court to figure out what happens, pay back the money, because that's going to be very complicated.
Got it.
Peter, I want to end with this. Is that your thesis seems to be that fiscal policy is not going to be tethered anytime soon. So we're probably going to have to rely on the Fed to mitigate the damages as best they can for as long as they can. Do you think the Fed is up to it?
I think they can be up to it. I think the question of personnel and whether the president's going to change a number of governors soon and replace Chairman Powell with someone else in the new year, that will have a profound impact on whether the Fed can navigate what would be difficult anyway, given where our economy is. As inflation is still a little too high and the labor market's a little too soft, is what it looks like. So I think the Fed can be up to it, but if you change the personnel enough, then that would change my assessment.
Well, we're going to have to leave it there on that sort of what do you call it?
Ominous,
kind of a
ominous.
ominous note, and so we'll see.
It's a
Like
teaser for the next installment.
exactly, like a mystery. But anyway, you've been listening to Facing the Future. I'm your host, Bob Bixby. Concord Coalition Executive Director Carolyn Bourneau and I have been talking with Dr. Peter Fisher of MIT and formerly of the Tuck School and formerly Undersecretary of Treasury for Domestic Finance. I'll be back next week with another edition of Facing the Future.